Hey there, and welcome. Today, we're going to tackle a big one, whole life insurance. It's one of those financial products that a lot of people have heard of, but maybe don't really get. So we're going to break it all down, what it is, how it actually works, and the thinking behind its design.
But before we dive deep, I want you to think about this one question, because it really gets to the heart of everything. Are you planning for something that might happen, or for something that absolutely will happen? Keep that in the back of your mind, because how you answer that changes everything.
And that question leads us right to this, the big fork in the road of life insurance. On one side, you've got term life. That's all about the if. If you pass away during a certain time frame, it pays out. But what we're talking about today, whole life, that's on the other side. It's built for the when. It's not about a possibility. It's designed around a certainty.
All right, so here's how we're going to break this down. First, we'll cover what insurance for your lifetime really means. Then we'll look at how it's kind of like a two-in-one deal. After that, we'll get into how your money grows inside it. We'll touch on the different ways you can pay for it, and finally, we'll wrap up with the most important takeaways. Ready? Let's go.
Okay, Section 1, Insurance for Your Lifetime. This is really the core promise of the whole thing.
So what exactly is it? Well, the simplest way to put it is this. Whole life insurance is permanent. It's designed to pay out when you pass away, period. Doesn't matter if that's next year or 50 years from now. As long as you keep paying your premiums, that coverage is locked in for your entire life. It doesn't expire, you never have to renew it.
And here's the best part, honestly. It's completely predictable. There are these core features that are just locked in from the moment you start. First, your death benefit, the payout amount. It's level. It never changes. Second, your premium, what you pay, is fixed. It will never, ever go up. And third, there's a cash savings value built right in that's guaranteed to grow. The whole thing is engineered to mature at age 100, which just means the cash value inside the policy will equal the death benefit.
All right, let's dig into that a little more, because this is really a two-in-one policy. It's got both protection and a savings element.
So component number one is the death benefit. I like to think of it as your protection shield. This is that fixed face amount of the policy that gets paid your loved ones when you're gone. And, this is the whole reason we even think about life insurance, right? To protect them.
Then you've got component number 2, the cash value. If the death benefit is a shield, think of this as your savings bucket. With every premium you pay, a little piece goes into this bucket, and it's guaranteed to grow. And what's really cool is this is a living benefit. You can actually use this money while you're still around.
Yeah, and this quote really nails it. It says the cash value is the amount of money the policy owner will receive if the policy is ever surrendered. That's a fancy way of saying it's your equity in the policy. It's the part that's actually yours. Okay, this is where it gets really interesting. How does that savings bucket actually, grow? Let's pop the hood and look at the engine of a whole life policy. To really see this in action, let's make up a guy. We'll call him John. Let's say John is 30 and he just bought a $100,000 whole life policy. So in the very beginning, most of what John pays goes toward the pure insurance cost. But then, around year 3, things start to happen. His cash value starts building up. By the time he's had the policy for 10 years, his little savings bucket has, say, $15,000 in it. Now, let's jump way ahead. By year 35, he's got $50,000 in there. And if John makes it all the way to 100, his cash value hits the full $100,000, exactly the same as the death benefit. The policy matures, and the company just cuts him a check for the full amount.
Now, this chart shows something really important. It's all about the insurance company's risk. Look, back in year 10, when John had $15,000 in cash value, the company was only really on the hook for the other $85,000, right? Then when his cash value hit $50,000, the risk dropped to just $50,000. And this is the secret sauce. Because the risk goes down every single year as your cash value goes up, they can guarantee its growth. It's not a guess, it's just math. That's why it's so predictable. Okay, so the policy itself is permanent, but how you pay for it, well, that's more flexible. Let's look at the 3 main ways to do it.
First, you've got the marathon. This is called straight whole life, and it's the most common one you'll see. You just pay a nice, steady premium every year until you hit age 100. Simple, consistent, predictable, just like a long, steady run.
Then there's the sprint. This one is called limited pay whole life. The deal here is you pay higher premiums, but only for a set amount of time, maybe for 20 years or until you're 65. And then you're done. No more payments, ever. But the coverage? It's still there, permanently. The policy is all paid up.
And last, you have the one-shot, single premium whole life.
And yeah, it's exactly what it sounds like. You fund the entire policy with one big lump sum payment right at the beginning. It's like doing the entire sprint in a single leap, and it gives you a chunk of cash value right away. So let's just put it all together. As you can see, no matter which one you pick, the death benefit is level. The real difference is how you pay. Straight Life is that long marathon of fixed payments. Limited Pay is the sprint with higher payments for a shorter time, which also means the cash value builds up faster at the start. And Single Premium is that one-shot deal, giving you immediate cash value.
All right, we have covered a ton of ground, so let's boil it all down to the key takeaways. This is the stuff you really need to remember.
Okay, here's your whole life blueprint. 1. It's permanent. It's for the when, not the if. 2. It's two things in one, a death benefit and a growing cash value. 3. That cash value grows and reduces the insurance company's risk, which is why its growth is guaranteed. It's designed to equal the face amount at age 100. 4. Straight, limited, single premium, they're all just different ways to pay for the same thing. And 5, and this is a big one, your cash value is an asset. You can borrow against it or even just cash it in if you need to.
So that brings us right back to the beginning. We've seen that whole life is built on this bedrock of permanence and predictability. There's a lot of certainty there. So the big question to leave you with isn't just how does it work, but what role, if any, should that kind of permanent foundation play in your financial story?